Welcome to BR Bites. I'm John Ball and I'm here with Nimesh Shah to talk about year-end planning. So Nimesh, Christmas is nearly upon us and we're here to talk about year-end planning.
I'm a really big believer in getting your planning done early. It's human nature to leave it until the end of the year. Most people leave their tax planning until the end of March, but getting it done early can have some real benefits. Christmas isn't far away, there's lots going on. Tax returns are due by the end of January. Tax payments are due as well. There could be some really big liabilities. Getting your tax planning done at the start of the year can have some real savings.
So let's start to talk about those savings, and probably one of the more straightforward things we can tick off the list are ISAs.
Most people know about ISAs, and I was round at my parents' house on the 10th of April at the start of the tax year. By the end of that evening, both mum and dad had £20,000 in their ISA accounts. That actually can add up. Take a family of four, £80,000 in their ISAs. Doing it at the start of the year, assuming that they're top-rate taxpayers, a conservative rate of return, that can actually add up to £1,000 of tax saved by doing it at the start of the year rather than the end of the year.
So pretty easy win. Are there any other ISAs out there?
The government's introduced lots of ISAs over the years. The entry-level ISA is the junior ISA for someone who's aged under 18. Mum and dad can contribute around £4,000 for their children, and that can build up until the age of 18. Once you're over the age of 16, you can actually contribute to the main adult ISA, the £20,000 ISA allowance. If you're eligible as well, the government's introduced something called the lifetime ISA. You need to be under the age of 40. You can put £4,000 in. The government gives you £1,000 as a top-up, but you need to watch out. If you want to access those savings, you can only do so on one of two things. One, by buying your first property, or secondly, on retirement age, which under the lifetime ISA regime is 60.
So some compelling reasons there to really use ISAs and use that maximum benefit. Thinking about some more complex things, and certainly things that cause us grief in terms of calculations, pensions.
Well, I think pensions and complicated go hand in hand these days. The government's changed the pension rules so much over the last few years, and actually working out how much I can contribute and get tax relief on is probably the most complicated thing. So doing it early is really important. So we have something called the annual allowance, which is £40,000, but depending on the amount of your income, that annual allowance can change every year. So someone earning over 150,000 can face a slightly reduced annual allowance. Also, you can carry forward unused allowances from the last 3 years. But all of this means you need to work out what that contribution can look like this year. So getting the information from the pension company, looking at the contributions that you've made, looking at your income levels, and sitting down and working out that number can take some time. I don't want to be doing it on the 31st of March, and getting it done early, there's no downside to doing that, and you've got your money into a tax-free environment.
Certainly seems a no-brainer to get that done as early as possible. What about some things that give some more generous tax reliefs? EIS, VCT?
These are interesting investments, and they are investments, so we need to watch out for that in the first instance. But if you find the right EIS or VCT investment, they can carry really generous tax reliefs. Both EIS and VCT, for every £1 you put in, you get 30p knocked off your income tax bill. For an EIS, there's something called capital gains deferral relief as well. So in a 4-year window where you've made a capital gain, you can defer the capital gain into the EIS, meaning you pay less tax, but that gain can come back into charge when you sell the EIS.
I see, so again, some compelling things to think about there, and certainly things to think about now in terms of actioning those investments. I guess you're going to tell me the same about gifting, something to action now.
Absolutely, and this isn't a year-end planning tip, but just something that everyone should be thinking about early. Gifting, if you do it soon, the clock can start ticking, and what we mean by that is we have a 7-year rule, which is always in the Sunday papers. But what does it mean? Well, when you make a gift, the value of that gift sticks in your estate for 7 years until it falls out of account for inheritance tax purposes. So making the gift early can start that clock ticking. If you're looking to make a really sizable gift or the gift of an asset, these things can take time. So making a bank transfer, gifting an asset, documenting that gift, again, all those things take time, and doing it early makes sense.
So I guess to summarise, some easy wins and certainly some things that take a bit of time to think about, and certainly things we should think about doing now. We'll see you next time.